Well, howdy there, folks. Welcome into this three videos up here for me to react to. First one up here is going over the CPI numbers that came out here today. It's a booming day in the market. Public accounts up $57,700 here today. I hope you guys are making a whole lot of money out there here today, folks. We got to talk about what this means for the market, what I think about these numbers in depth, what it means for the Fed, all those sorts of things. And in this video, we'll get into a little bit more of the Fed bar for further rate hikes getting higher and higher. So I want to hear what that gentleman has to say, kind of react to that guy and give my opinion about what I'm thinking the Fed's going to likely be up to in 2024. Then we're going to get into this one. Tesla is the biggest AI play in the world. Cathie Wood has some big comments around Tesla, and it's very intriguing because I don't know if you guys are aware of this or not, but Tesla is not her biggest position in the ARK fund anymore. I thought that was very surprising. Actually, going into today, it was actually her third biggest position. So right now, it's now up to her second biggest position. But I thought that was intriguing because it used to be Tesla was always the biggest. And so I just thought that was interesting that now it's not, folks. So yeah, hope you enjoyed today's video. As always, appreciate y'all joining me. New all-time high subscribers in the history channel. Appreciate each and every one of you. I think we're 36,300 plus subscribers strong now at this point in time, folks. 9 days until the once a year sale for Black Friday. Yes, once a year, folks. The 1 day sale is 9 days away. You get access to my Become a Master Stock Market course, which is usually a $997 course, ability to see the stocks I'm buying and selling in that Patreon portfolio, and exactly how I diversify my funds around. Plus, you get access to that Discord chat as well, all for $62. It's a no joke as holy smokers deal, folks. Check that out. Pin comment down there, enter in your info, and we'll send it over when that 1 day sale is on Black Friday. 9 days away. Alrighty, guys, let's get into this.
Standing by with the numbers. Say, Rick. Hi, good morning. Yes, October read on our consumer pricing.
Wow. Look at that right away. That's not humans doing that. I could tell you that. That's the machines. Certain number comes out, buy. And on the flip side, if a certain number came out, sell. So, man, I mean, just immediately that market just starts to skyrocket.
Month over month headline expected up 1/10 comes in at 0, unchanged 0, which equals the lowest we've seen on this metric since we hit our high at 1.2. That was in June of 22. That was the highest since 05. So 0 ties. That's the lowest we've been. And if you strip out the all-important food and energy, it's up 2/10. That's 1/10 cooler both than expectations and the rear view mirror. Year over year headline up 3.2%, 1/10 lighter than expectations, 0.5% less than the 3.7 look last time. 3.2, just to put a face on.
So
3.0.
3.2, let's be very clear about this. Let's be very clear. This is a little better than expectations. 3.3 expected, 3.2. Let's be clear about this. The reason the market's skyrocketing today off of this CPI number is not because we slightly beat. It's because Wall Street's looking to push this market right now. We know Wall Street's looking to push this market. We know they're looking for a Santa Claus rally. This is just something we know, right? They've talked about it. I've reacted to a million videos. Everybody and their grandma on Wall Street talking about Santa Claus rally. Market's going to, move another 8-10% into year end. Dan Ives yesterday, right? And so there's just a lot of fund managers that are very underperforming the market, and they're trying to play catch up, and so they need this market to move into year end, and that's obviously what they're trying to do here, okay? And so, at the end of the day, I look at something like this, and it's just, Wall Street being Wall Street, right? Because I can tell you, we've had numbers come out a little better than expectations, and then the market didn't move that much. And then today, a little better than expectations, and the market just, obviously is skyrocketing. So that's the,
June of
Wall Street
this
being
year
Wall Street.
was the lowest since March of 21. So we're still above that level. And finally, what I would consider.
That's why I just always stay invested, man. Because Wall Street's going to push the market whenever they want to push the market. That's the bottom line is. And I don't know exactly when that moment's going to be. They're going to push the market right now. So the bottom line is I stay invested. They'll push it when they want to push it, and then they'll lay back when they want to lay back. And that's just going to be what it's going to be.
Actually, the most important, even though it's ex-food and energy, is year-over-year CPI, 4%. 1/10 lighter than we were expecting, 1/10 lighter than our last look, which was 4.1. And the metric there, and this is a biggie, we haven't been under 4% since May of 2021. Yes, under 4% since May of 2021, although this is the lowest level since 6.6, which was a high watermark in September of last year. Now, if you look at the markets, interest rates have moved down. We moved from basically 461 in 10s down to its...
And why are interest rates all moving down? Well, a number like this gives even more confidence in the market that we're not going any higher. The Fed's not going any higher anytime soon, and the next move the Fed will make will be cuts. Whenever that comes, whether that's 2024, 2025, and we'll talk about that in a moment. But that's the market's view, and that's why you see treasuries going down. You see treasuries going down. What does that mean? Usually stocks going up.
Level at 447, which equals our intraday low test that we had last week. So you want to pay particularly close attention. And the pre-opening Dow futures have moved higher as well, dramatically higher as well, like 300 points higher as well. So
okay, wait, hold your horses for just a moment. Hold your horses for just a flip and flapjacking moment, okay? 300 points in the Dow. Nowadays is nothing, like literally nothing, okay? I know Rick Santelli's been around for many, many decades, right? So maybe 300 in his brain sounds like a lot. It's nothing. Like, that's not even a 1% move. A 300-point move is not even, like, you got to push the Dow 600 plus points to even get a 2% move, which is like, oh, that's a good day for the market, but it's not something crazy. Like, I've been in the market 15 years, and the amount of times I've seen the Dow move 2, 3, 4, 5, 6%, it's a lot of times, okay? And so just keep in mind, like, as a percent basis, it's actually a very small move, considering how bullish kind of Wall Street wants this market right now, which is very, very bullish.
Numbers being taken as a good sign, and I understand why, especially if you look at
That's a nice move there, 252 in the NASDAQ.
Over month, and you start interpolating out. But I will still leave us all with the notion that 4% year over year, X, very important food and energy. And by the way, all these stories about EVs and power grids and losses on transition, they're not going away. These numbers for energy and pockets of energy are going to stay firm. But that is the number I think is important. All the metrics have moved lower. And as I said, even though all of these have moved lower, they haven't really taken out, other than the headline equaling the lowest level since our high water mark. The others still are comping above levels that were lower. The 3.2 is obviously good news, but as I said, it was 3% in June. We want to pay more attention to how this transitions into the actual opening, but we'll toss it back to the panel to debate some of these numbers. Joe, back to you.
Yeah, immediate reactions, though, and pretty bigger than we've seen recently. Stay with us. Let's bring in our senior economics reporter, Steve Leisman, along with Joe Lavorgna, chief economist at SMBC Nikko Securities, and Kitty Richards, a former Treasury Department official under President Biden, also served as an economic advisor to the president when he was vice president. Steve, we'll go to you first. And I think one of the things Rick said was that 4.5 we saw has been breached on the downside for the 10 years. So that sort of, I don't know, that's kind of like a confirmation of that move maybe at this time because of the CPI number.
Yeah, I think that's right, Joe. There has not been a lot of inflation in the move up in interest rates, and it's interesting to see some move down in it. It's not quite there yet, but we're still quite a bit above financial conditions being tighter. But this is a good report. There were some surprises to the downside, and it's been a bit since we've had surprises to the downside. We're incrementally making progress towards the Fed's goals here. One of the big standouts here was the owner's equivalent rent, which is the proxy for housing, down to 0.4% after 0.6%, surprising to the upside in the prior month. You got gas down 5%. That's headline stuff, not really a big issue. Used cars down 0.8%. That's a big number there. Physician services also down 1%, while hospital services were up. And just one quick, airline fares down 0.9%. So that probably comes along a way that energy seeps into the service sector. So I think that if you were to draw, let's say the Fed was equidistant here between hiking and not hiking, this is an incremental move towards not hiking again. So I think the market likes it that way, Joe.
Yeah, and so what have I been telling you guys for the last few months, right? I've been telling you that inflation is basically a non-factor for 2024. And the reason I have huge confidence in saying inflation is a non-factor for 2024 is I look at all the major components that make up inflation, right? Housing. Good luck selling your house in the next 6 to 12 months, and especially for any sort of higher price. If anything, you're going to have to be extremely competitive if you want to go to sell your house in the next 6 to 12 months. Rents. We have more rental inventory hitting the market than ever with all the new apartment buildings that are being built that are all coming online right now. Obviously, it's already a tougher rental environment in a lot of markets, and I've definitely experienced that in the last, I would say, year or two. And so I look at something like that, and I say rents aren't going to be an issue for the next, year at least, right? As far as commodities go, which commodities are a huge component of why we had the sky-high inflation we had, because all those commodities end up going into everything. We had a crazy bull cycle from basically coming out of Rona into 2022 is a crazy bull cycle in commodities. Commodities haven't gone anywhere in the past year. Look at GSG. It's actually down in the past year. So commodities aren't really an issue. So you look out there across the board, housing, rents, think about autos. If you want to sell autos, you better be extremely competitive on price for this next 6 to 12 months. Bottom line. And so that basically means 2024 inflation is not an issue. Now, could inflation always come back in 2025, 2026, 2027? Sure. It could always come back in future years, right? But in terms of this next year, which we can actually see and actually have visibility, it's going to be a non-factor for the next year. And so that's obviously a good thing for the market because that basically takes the Fed out of raising rates anymore. That takes them out completely for at least the next 6 to 12 months. Once again, future years, 3 years from now, it could be a whole different ballgame. 2 years from now, it could be a whole different ballgame. But for the next 6 to 12 months, the Fed's not raising because we're going to the twos as far as inflation. Next one up here. Bar is for further rate hikes getting higher and higher. Let's speak about this a little more in depth.
The all clear for the Fed.
It does for right now, Lisa. I mean, these numbers are going to bounce around on a month-by-month basis. I wouldn't, our view is that the Fed probably is done, but I don't expect Fed officials to be coming out just because of this one report saying, oh, it's all clear, everything's great out there. I mean, I think they're still going to continue to be biased to potentially tightening. We don't think that will happen. But, if in the next few months, these numbers kind of reverse and they kind of pop up and the economy expands at a stronger than expected rate, you could potentially see them going. But again, I think that's a high bar at this point.
This adds to signs that there is some sort of...
So in terms of the Fed, and in terms of, are they going to declare victory? Because I think that's a lot of people are wondering, when does the Fed declare victory, right? Because that's seen as a big moment for the market where the Fed declares victory, we defeated inflation, and we're moving up from here, right? My opinion is they will declare victory when we have several months in the twos in a row. That's when they'll go out there and declare victory, and that's when they'll announce they're done raising rates, and maybe at that point in time they'll mention about considering cutting. But in terms of cutting rates, when's that going to happen? That's in terms of any substantial cutting in rates, they're not going to do that until they get a weak economy. And I mean a weak economy where you see unemployment starting to skyrocket 4.5%, 5%. That's the moment the Fed would actually start cutting. Outside of that, they're not going to be in a big rush to cut rates. And if they were to cut rates at all, and we had a strong economy, it will be super small cuts that are almost meaningless, like quarter point cut or half point cut. So, but if the economy stays, let's say the economy's hot in 2024, they're likely not even going to cut rates in 2024. They'll likely wait until they see some sort of major deterioration in the underlying economy.
And this is the reason why so many people are talking about a soft landing, because you haven't seen the real cracks you'd expect ahead of a massive recession. Jay, do you think that is an accurate categorization of exactly what we're seeing with prices not going up as much as people had expected?
Yeah, I think that's right. If we were still clipping along at a year-over-year rate on the core of a 5%, we'd be talking about the Fed hiking even more. And when you start to hike even more, that's when you have the problems. So the potential for a soft landing is still there. I guess what I'm a little bit still watching and concerned about is that the real Fed funds rate, the nominal rate minus some sort of inflation rate, continues to drift higher, and that's what matters for the real economy. And so I think the Fed's going to delay easing at this point. And so we may or may not have a downturn early next year, but I think the next few quarters, because monetary policy is going to remain restrictive, I think you're looking at headwinds on economic growth.
If for any reason we did have a weaker economy, let's call it in the first quarter, second quarter of 2024, that would be a moment the Fed will start to at least consider cutting rates, because we'll be, it's almost a guarantee we're going to be in the twos during the first quarter, second quarter of 2024, right? And so we'll be in the twos, and then if we saw any sort of real economic weakness, the Fed would start to at least consider cutting rates in the springtime, but they probably wouldn't make the move until summer. But that's assuming the economy was to be weak during that particular time period.
Mission accomplished. There's a comedy to that, a painful comedy for our geopolitics, our history, Dr. Bryson. But are we getting to a transitory point where this Federal Reserve can say, mission accomplished?
Well, again, Tom, I don't think they're going to come out and say that right at this point. But, what I would say is the bar for further rate hikes is getting higher and higher at this point. Many of the members on the FOMC think they have done enough at this point. And, today's rally in the 10-year notwithstanding, we still have seen, relatively high long-term rates. And so there's a fair amount of headwinds on the economy right now. Again, they're not going to come out and say mission accomplished right now. They need to see a few more months of this before I think they feel confident in that. This is certainly a good start in that journey, but I still think you need to see a few more months of 0.2s before they say mission accomplished.
So there's a lot of people that are hoping the Federal Reserve starts cutting rates in 2024, and I'm here to tell you today, do not hope they cut rates in 2024. Why do I say that? The reason being is usually when the Federal Reserve starts cutting rates, it's usually a very bearish signal for the market many times. And the reason being is if they're cutting rates, it's usually seen as, there's recession ahead, we're going into recession, maybe we're already in recession, job losses, those sorts of things. And so just because the Fed cuts rates doesn't always mean it's necessarily a good thing, especially if they start cutting substantially. You go back to, 07, 08, into 09, right? Fed in that time period, in a matter of a year or so, basically cut rates from, a fairly elevated place down to zero in a matter of 12 to 18 months. And you can say, wow, that must have been great. No, it was horrible. The market fell, 50% during that time. The index peaked to trough, right? And so if we have a situation where rates actually stay where they're at, Fed funds rate, for 2024, that likely means the stock market had a very good year. That likely means the economy had a very good year. And that likely means an unemployment rate stayed under 4%. That's what that will likely mean. If we do have any sort of substantial cuts in 2024, it likely means that the stock market fell apart, the economy fell apart, jobs fell apart, and we had a whole bunch of issues, okay? And so I just think that's an important thing that everybody's got to understand. Next one up here, Tesla. Tesla is the biggest AI play in the world. Let's hear Cathie Wood speak about Tesla, as well as why has it gone down in terms of it's not her biggest position anymore. That should be interesting.
Very bullish on autonomy, vehicle autonomy, of ETF all around it, robotics and the like. What do you make of what's happened with Cruise?
Yes.
The shutdown of Cruise, at least the temporary suspension of it. Derek Khosrowshahi, who runs Uber, was on the broadcast last week. He said he doesn't think that autonomy, in terms of autonomous vehicles or robo-taxis or the like, are a real thing for another 5 or 10 years. Meaning, and by the way, I think 5 or 10 years ago, he would have said 5 or 10 years ago, that was what,
so would Elon, yes.
And so here we are.
Yes.
So what have you changed your view about that? No. I mean, you must have, because I imagine if we go get tape of a conversation that we all probably had 5 or 10 years ago, we probably said 5 or 10 years from now.
22, 23, right. 24. We actually delay ours by 1 year relative to Elon, so maybe it should be 2 years. But
yeah, Cathie Wood thought we would already have robo-taxis and all this stuff by now. Let's just be quite clear about that. Okay, so, that's why, if you always heard me speak about Tesla stock, I've never banked in like the robo-taxi opportunity. It's a call option on Tesla, right? And that's where I think Cathie Wood's maybe a little misguided, and some people are very misguided. They've been running these projections for Tesla's, autonomous taxi network, and it's like, we'll see when we get there. You can't just start throwing out numbers. We don't know what that business is going to be. We don't know what the margin is going to be. We don't know what the profitability is going to be. The auto business, we can get a gauge on where likely margins will be, where volumes will be, average selling prices. You can run numbers. You can run projections on that. Robo-taxi, you can't run anything on that. You're just throwing darts at a dartboard. I'm going to assume they're going to make this margin. No, it doesn't work like that. I'm assuming it's going to start this year. Everybody's been wrong on this year after year after year after year. We keep pushing it out, right?
Here's where we've learned how important Tesla's proprietary data is. It's 5 million robots around the world. Cruise didn't have anything like that. It had hundreds. 5 million robots around the world collect data every day and send it back to Tesla.
Yes, 100%. And so for Tesla, it's about how do we use that data, right? And how do we make sure that data is helping us out in an immense way. It's one thing to have the data, but it's another thing to be able to apply that data and have it help you ultimately create the best autonomous taxi network in the world that ultimately is not just dramatically safer than humans, but is near perfection, because that's what the regulators are going to want to see. They're going to want to see near perfection in regards to this to really have it take off, certainly around most big cities, big states, and around the world. That's what they're going to need to be
more corner
perfect.
cases, which means disengagements, accidents, information like that, than all the other companies in the world combined.
100%.
And I have to tell you, watching the breakthroughs in AI that we are seeing, they are astounding, the speed at which this is moving.
Right.
So it is interesting.
100%.
I think it's a data issue. Autonomous taxi platforms are the biggest AI.
It's not a data issue. It's a being able to use the data efficiently, and so you can have near perfection, right? Tesla's had so much data for a long time, but they haven't been able to use it enough to have the autonomous taxi network opportunity be there yet, right? It still keeps getting pushed out year after year after year. In self-driving vehicles, why can't they drive as good as a human? They still can, actually, right? I watch a lot of these videos, and obviously I have Teslas as well, and I know people that have. The system's still not to human level. Like a good human driver, that is, it probably drives better than some bad human drivers. But in terms of a good human driver, it's still not better. It still makes a lot of questionable decisions. It still acts, I would say, very, in certain situations, it acts very unhuman-like in terms of its driving ability, where it's like, oh my gosh, like who's driving this, a grandma? So we got still progress to be made. And that's the main thing. We still got a lot of progress to make here.
Project in the world, and therefore
the last 5% is everything in driving. That's the thing. Like 95% is cake. It's the 5% of weird situations that you get into on the road, construction, this, that, right? Signs that don't make any damn sense, lines that aren't lining up. Those are the situations that's the hardest part, and that's what Tesla's really been trying to perfect over the last few years, and it's a difficult job.
Tesla is the
But you have you've sold Tesla shares, and it's it used to be the number one holding, I believe, in your ETF. It's now number 3. You've sold about 20 million shares.
Yes.
Why?
So, well, whenever it goes up, it was up about 150% relative to our other names, many of which had not moved. So we will always recycle that way, take profits. And I would also say, listening to Elon on the last conference call, he's very concerned about the economy, as we are.
Cathie, will I look outside 5 years from now and see GM and Ford even?
I think they should have let her go a little longer. And that's one of the issues I think a lot of folks have had with Cathie Wood is, she has a super long-term time horizon she talks about, right? But then, she makes moves like that, and then she'll sell a bunch of Tesla shares, and people are like, what's going on here, right? And if we look, Tesla's not even close to being a 10% weight right now. It's actually 7%. So I can understand if she was like, well, it became so overweighted. We were, because basically I believe in this ETF, they've got to keep everything under a 10% weight. So I understand, like, if it went over 10%, she's like, oh, we got to sell for that reason. But right now, it's not even remotely close. That's 7% of the weight, right? And so I think that's something that frustrates a lot of individuals.
Everywhere.
It's very interesting to hear both of them pull back saying,
but do you think, with this new way, I don't even know if we'll be talking about GM and Ford in 5 years.
What is interesting about the news that both of them are pulling back for profitability reasons, they can't be profitable in this space unless they scale. That's how this works.
It's a catch-22.
So it's catch-22, and their shareholder base is very internal combustion engine oriented, and they want their profits now, and they want their dividends now. And they don't want that kind of investment in losses.
Will they be able to?
I don't know. All I know is, back to the Tesla question, as they are pulling away, our market share expectations for Tesla go up.
Right.
And so to answer the question, we sold as it was up 150% relative to everything else. We have not sold much since then. And it will, if we're right on this autonomous taxi opportunity, it will remain in the top 5 in our fund, in our flagship.
So we'll talk about market share in just a moment, which I think that was a really important point she just brought up in regards to market share. But, to answer his question, are we going to see, a ton of Ford and GM EVs flying around 5-10 years from now? I would say the probability of that is looking lower and lower and lower. They can't move these things. Ford tries to, throw a bunch of these EVs at the dealerships, and the dealerships can't move them. And so, and then if they're not investing in them much further because their shareholder base is mad and these stocks aren't performing, it's a mess, man. It's an absolute mess. And so, as I've always said, in regards to my opinion on this, you're going to see consolidation. You're going to see the weakest companies get bought out by still weak companies. That's what you're going to ultimately see. And I think that's going to play out over a 5-10 year span. I don't think it's something that plays out overnight. I think it's over the next 5-10 years, right? Because still, at the end of the day, there's more internal combustion engine vehicles sold on a yearly basis by far, right, in the United States than EVs. At some point, that flip's going to happen, right? And then, it's just going to be a slow grind lower and lower and lower for ultimately many of those companies, right? Now, in regards to market share, she brings up a phenomenal point there, phenomenal point, and this is very important. If they're not going to have any competition really from the big players, the Fords and the GMs and the Volkswagens, the traditional makers, right? And many of the smaller EV players are likely, going to face bankruptcy or going to get close to it, right? Like the Lucids and, any of those other companies you want to throw in there, the Fiskars and all those other stocks, right? Rivian looks pretty well positioned, but they still got a lot of progress to make in regards to their financials, their income statement, right? I mean, damn, it gets even more bullish for Tesla's market share over the coming years. If you don't have the traditional guys who already are just, embarrassing themselves in that space, and then the smaller players are looking at potential bankruptcy, it's a better situation than ever for Tesla for market share over this next 5 years. And so that's another thing to be kind of factored in there that I think is very important, folks. So appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed to the channel. New all-time high subscribers in the history of the channel. We are a mere 9 days away from the once a year massive sale, Black Friday, $62. You get access to my #1 stock market course ever. It's usually a $997 standalone product, as well as seeing exactly how I build up a portfolio. I mean, it is super, super valuable. Pin comment down there for access to that, enter in your info, and we'll send you over the deal as soon as it drops on Black Friday. It's a 1-day sale. Much love and have a great day.